Thank you to this webinar. Juan and I are excited to talk about what we know about investing. And I think most of you have already been introduced to our angel network, but we are focused on environmental and social impact. And we've grown. We started off with 6 or 7 angels beginning in 2016, now have 53, and have invested as of today in 25 companies. I added a strap to the list of $5.9 million. And there's both an Austin chapter, and with Heather's capable help and Chris's interest, we have a Dallas chapter. Thank you, Chris.
Thank you.
So we're going to talk about sort of the big picture just briefly about how investing works over time. Then we're going to spend some time on the various instruments: convertible debt, preferred equity, royalty-based financing, and then give you some data on what angel investing looks like based on some industry results from the Angel Capital Association. And then we'll go through sort of a detailed spreadsheet example of how the valuation of startup companies changes over time for the good or the bad, and then how we get involved after we invest and what are some tax considerations. So a lot of slides here in just an hour, so we'll go through fairly quickly, but I would encourage you to ask questions, interrupt, make comments, because Juan and I both take energy from you during these meetings. We don't get energy from just talking. So in a typical environment for a life cycle of a company, they get created, the employees have common stock. Angels typically are the next investment level, and we make a loan or buy preferred stock. The loan generally converts to preferred stock later. And then VCs come in with multiple rounds of financing. They call them Series A, Series B, Series C. And any kind of loans we made are converted to that Series A stock. And that's in years 3 through 5. And then by year 7, an exit is expected, either an acquisition or an IPO. Maybe it's 10 years, maybe it's 7, but that's the general model. So we're coming in pretty early in the company's life, and we expect some bigger investors to come in behind us as part of this process. And none of us get a return until that exit happens. Questions, comments?
I think, the big thing that's missing, Bob, is obviously there's a significant portion of these companies that go to zero. So that's also an exit, although not a positive one.
That's true. So one of the key things we'll talk about through this presentation is the idea of a valuation. So if a company is valued, it says we have a certain number of shares at a certain stock price. That's the valuation. And there's a valuation put on the company before an investment is made. You add the investment dollars in, and that gives you a post-money valuation. So 2 + 1 = 3. So in this simple model, the investors now own 1/3 of the company because they have 1 million of the 3 million valuation. And so the term pre-money is used when stock is being purchased. There's a similar term called valuation cap, which we'll go into later, which also applies to cap the future pre-money for convertible debt. And we'll talk a lot more about that later. Any questions on that? That's good.
I would just add real quickly here, Bob, that even though these are not, quote unquote, liquid markets, they're still markets, and these figures all come from market. And that market might be 3 or 4 different investors just nodding their head and agreeing that $2 million pre makes sense.
Yes.
Okay.
So another key concept is a up round or a down round. An up round means that when you go from a Series A to a Series B, the stock price, preferred stock price, has gone up. A down round says when you've gone from a Series maybe B to a Series C, the new stock sold to investors has gone down. And in this example, you can see the dollars invested by the angels, $600,000. That money's in, that's what we've invested. And as other investors come in, the blue line goes up. But if the stock price of the preferred stock is not going up, as you can see on the right, that's a down round. And what happens is that the value we have, our percent, the dollars we have in terms of owning a portion of the company can go up for an up round or can go down in a down round. And we can end up in a negative position relative to the amount of money we invested if the new preferred stock is low. And this is just, we'll go through a lot more details on that, but it's just to give you a sort of a visual sense of what an up round and a down round is. Questions, comments?
Yeah, one question. I see on the down round example that between Series B and C, the share price rises, yet the angel investment valuation decreases. Why is that?
It's because so much money was put in at a relatively low price in Series C that our percent ownership went down, and we'll show you some example of that. Good question.
Okay. Thank you.
So investment instruments. There's really 4 ways for investors to make money. One is, there's an exit called a merger and acquisition. Pretty obvious what that is, or initial public offering of stock. And those all happen when we've had shares issued to us, stock issued to us. There's 2 others which are not stock-based. One is revenue-based financing or venture debt, where we give the company some money and they agree to pay us back a larger amount. It sort of looks like a loan, but it's not really, because it's a fixed investment return that they agree to. We'll talk more about that. The other option is that we're investing in a LLC, a limited liability corporation, which has no stock. It just has partners who own a portion of the LLC. And in that case, we'll own a portion of the LLC also as investors. And so any profits or losses of the LLC flow to us on a yearly basis. So let's talk some more about these, starting off just again, sort of the life cycle. Common stock is what founders have. Typically, the founders don't get any additional shares. They may get a few options, but their kind of percent ownership is fixed until there's an IPO or an M&A, in which case they can sell their shares. Employees typically get options to buy common stock, and typically they don't exercise that until there's an exit event, in which case their common stock can be traded also. Equity investors may do some sort of loan structure at the pre-seed or seed level, and typically at Series A, B, C, it's all preferred stock. And at the liquidity event, the preferred stock translates 1-to-1 into common stock and can be traded or sold. And we also, again, have these non-equity investment options as angels. Questions, comments?
I would just clarify the common stock for the founders. It's not a fixed amount. It in general only goes down. So over time, their percentage ownership may go down as they bring on more people or put more of their own stock in the employee stock purchase plan.
Yeah, and so that's exactly right. So on day one, the founders own 100% of the company. And then after a Series D and there's an IPO, they may own 10 or 15% of the company, because there have been so many shares given to employees and to investors. And that can be a win-win for them. If it's a big company, they can make a lot of money. Now, there are some exceptions. Facebook, I've forgotten the name of the CEO. He owns like 60% of the company still. That's a little different scenario. Usually there's a lot more dilution for the founders.
Zuckerberg.
So what is convertible debt? Debt is a way of us giving money to a company when they're not really ready to issue preferred stock yet. And they may not want to issue preferred stock yet because no one really knows how to value the company. It's 2 employees. They're not yet in the marketplace. How do you put a value? What is their company worth? And so what happens is that loan will convert automatically into Series A stock when the first Series A happens. And we'll get some better terms at Series A conversion than new Series A investors will. We'll talk some more about that. And while it's a loan, as an investor, you have to think of it as not really recoverable if the company's not doing well. Why? Because they spent all that money, they have no money left to pay you. It's pretty simple. And so there's some key terms on convertible debt. One of them is the valuation cap. So, the way this works, convertible debt works, is you give them some money, we'll call it $500,000. We have earned some interest on that. So maybe our equivalent worth now is $550,000. And the Series A stock price gets discounted to us. So we may only pay 80% of the Series A price. So that makes our buying power maybe more like $650,000. And so there's a pre-money, and then there's the $650,000 buy shares to give a post-money. Well, what happens if an investor comes in and says, we're going to value this company at $1 billion pre-money? That means our $650,000 is nothing. And so we have a valuation cap, which basically says, when you think about the pre-money that applies to our $650,000, the pre-money is capped at this number. So we get some kind of decent percent ownership. So that basically talks about most of what's on this slide. There is always a definition of what constitutes a Series A. If they go raise $5,000 from a buddy, that's not a Series A. It has to be a certain amount of money. And there's a maturity date, maybe 2 years out, at which we can ask for our money back or force a conversion into preferred stock, even if a Series A has not happened. A lot of stuff I threw at you. What kind of questions do you have or comments, Juan?
I would just say, as a comment to investors who are just looking at this for the first time, is that investing in early stage companies is highly, highly risky, and valuation of those companies is highly variable. But the good thing is, because of the valuation cap and the discount rate, a lot of that can be managed, and then there is an opportunity for reward for taking that risk, and that's kind of the way I think about both the valuation cap and the discount rate.
Right.
There's an example at the bottom. One of our companies, Yada Energy, we did a safe note that's a form of convertible debt, and we at Series A we paid 35 cents a share versus new investors paying 44 cents a share.
So we got rewarded, as I said, for our early belief in the company, our early investment in the company.
Yes. So I won't read through these for you or try to talk through all of those, but there's a whole lot of additional terms in there that we can put into a term sheet and get in there. In some cases, we ask for a board seat or a board observer seat. We can say that we won't invest until, from all investors, at least a certain amount of money is put into the company, because if we put in a small amount and they get no more funding, that money's at high risk. You need a certain amount of money to make progress, and we want to be only investing when they get that certain amount of money. So those are all the kind of terms. If you have any, read through those, have any questions, we can pause here and discuss those.
I think that the biggest thing to take away from here, Bob, is that all deals are a little bit different. There's similar structures to just about all of them, but they're all a little different. And for me, that's one of the benefits and why I joined Swan, is to have a bunch of different viewpoints and have someone like Bob, who's seen a bunch of these deals, to help put together these deal terms and control as many of the variables as we can. Now, again, it's still highly risky, but there are some things you can control, and it's good to be able to do that when you're putting the deal terms together.
What's the consequence if they breach some of those? How enforceable are they?
Well,
especially if they
well,
really want to mess around with you.
how much money do you want to spend on a lawsuit? I don't know. But generally, they aren't
Yeah.
enforced very much, I don't think. But
It's very difficult. Yeah.
I mean, one
It's
thing that
more
can
about their
happen.
willingness to.
Oh, go ahead.
Go ahead, Bob.
I was going to say one that can happen is that, if you have a reasonable position on the board of directors, you can try to replace the CEO. That's probably the most usual remedy if they're no longer trustworthy and they're not being honest with you. If there's enough support on the board to get rid of the CEO, that happens.
You never want to use any of these covenants, but it's good to have them ahead of time so that everyone kind of can look each other in the eye and say that, this is our expectations of each other as we move forward. But it can get very messy and it can get very ugly. And the other thing is, if you break these covenants and, it's a people business, it makes it very difficult for another investor to come in who might want to invest if they know that you've broken some of these covenants with the previous investor. Why would I invest? How could I trust you?
Exactly right. And so, we will, if there's prior investors, we'll talk to those prior investors before we invest. And if the company is now viewed as untrustworthy, they're getting no more money. So this slide talks about what's a typical convertible debt valuation cap. There's so many things that go into that. And basically it comes down to, at some level, how excited are we about this company and its potential? That said, the most likely thing that we would use for pattern matching is their revenue numbers. If they're pre-revenue, generally we expect these companies to have a valuation cap 3 million or less. And with $1 million of revenue, then $5 to $10 million valuation cap makes sense. That said, sometimes the company has us really excited because they have really strong IP, or they have a team that we believe in because they've done IPOs before, in which case the valuation caps will float up higher than these numbers. So, it's just a matter, as we try to do risk assessment on these companies, do we think this is a really low risk startup that's going to do really well? We'll give them a higher valuation cap than we would otherwise.
The other thing we do here as we look at these companies is try to think about the signaling in the market that the valuation cap does, right? So our hope and expectation is that they bring on a professional or venture capital investment for their next round. And if we set the cap too low, that sets the signal that this company is not growing that fast. And if we set the cap too high and the company can't get the ARR to sustain that cap, then we send the message that they're growing too slow again. So that's the other thing that you have to consider about that and have a dialogue with the company about, what's kind of the range of cap that's going to make sense for follow-on funders.
Right. And so if we're the first investors in a company in this round, we negotiate all these terms. And if we get, as Juan was saying, if we get terms that don't make sense to other investors, either in the current round or the future round, then they can't raise money very easily.
Are you defining revenue as sales?
Yeah, it's easiest thing is cash in, right? Sometimes with sales, you can't recognize revenue until later years if it's a multi-year contract or something. But the fact that they have cash coming in from customers is what we'd be looking for.
So I would say it's annualized sales. So if you have a 3-year contract, what is it worth in year 1, 2, and 3?
So regardless of margin.
Yes,
Yeah.
but margin plays a role for sure.
Okay.
In these early stage
if you have
companies, if they're software based, the margins could be pretty good. If they're hardware companies, it may be kind of thin. Because they probably have cost reductions later for future hardware spends or better manufacturing partners, things like that. But it's a basic statement about how well the marketplace likes what they're doing. That's what the sales numbers tell you.
Okay.
So there are some alternatives to convertible debt. I really won't go into this. There's something called KISS. keep it simple securities and safe. Basically, angels like convertible notes better because they're more friendly to angel investors. And if you want to go into more detail, you can go look at one of these websites. And these slides are all available on our website. If you can pull these down, you don't need to take copious notes, Gail, you're welcome to, but yeah.
It helps me pay attention.
Sure. So the safe notes are the least liked investment instrument for angels. And there was originally a pre-money safe structure that angels really don't like. And there's a post-money safe, which is kind of replace it, which is more friendly to investors. And so sometimes we'll ask companies, is this a pre or post-money safe you're asking for? So, but all these terms, right? We talked about all these terms in the term sheet, all these different factors. What really matters is, do we think this company is going to be successful? Whether we earned 4% interest or 10% interest on the convertible debt note doesn't matter if the company fails. It only matters a little bit if the company is wildly successful, because we'll make a nice return. We do care about the valuation cap, because that directly defines what percent ownership we have. And that is the one factor we care about the most. So can the company be successful first? And what's our percent ownership second, is how we think about these. Revenue-based financing, we say, okay, we'll give you some money and you'll pay us back a certain amount by giving us a percentage of your gross revenue, not your net income, but your gross revenue. So typically we look at your annualized revenue, which is the current month times 12, and we'll give you a quarter of that amount of money. And we'll ask you to pay us back 5%, using 5% of your gross revenue, until you've paid us back typically twice what we gave you. So it sort of works like a loan, that there's payments over time, but the payback is fixed. It is not tied to a schedule. It's not an equal amount per month. It's tied to your revenue. So as your revenue is small, you pay us a little bit. As your revenue gets larger, you pay us a lot more. And companies can like this because they don't give up any equity. And there's no M&A pressure from the investors, because we're getting our money paid back in real time as opposed to at a future exit. And yeah, so that's kind of how it works. You better have good margins, gross margins, to be able to afford to pay us. And you typically are going to have probably at least $300,000 in annualized revenue, so we can give you some money, because 25% of 300 grand is only 75K. It's not much money to start with.
So we
Question?
see these sort of situations usually in like consumer goods, companies that need inventory, companies whose products are not that expensive and they could sell, several hundred in a month, and then who may not have the opportunity to ever become a huge venture backable kind of company. Good companies, but not supportive of those kinds of risks.
We also did this for a company. We'd originally put convertible debt into a company called Curb, and they were going through a merger and wanted to have some cash on their balance sheet so they have a better negotiating position with the acquirer. And we did a sizable revenue-based financing amount just to help them through that merger and to give them some some power in those discussions. Preferred stock. So what is preferred stock? It's typically a Delaware corporation who's giving stock to a VC. And we already talked about up rounds and down rounds. And the share price is met, as Juan said before, by negotiating with the investors. Why is it called preferred? Well, it's because they have lots of preferences, those shareholders, a lot more than common shareholders have. So for example, if there's an acquisition, the investors get their money back they invested before, any common shareholders get any money back. It's called the liquidation preference. That's a pretty powerful incentive to have preferred stock over common stock. And so it can work out, but if a company's raised $3 million and get acquired for $2 million, actually no money goes to the company. It all goes to the investors. And what happens is that the preferred stock price can be different than new stock options given to employees in the same time period as the preferred stock happening, because the preferred has all these protections. So if a preferred stock price might be $1, new stock options for new employees might be priced at a 10 cents strike price. So, okay, preferred has lots of things. They get to improve through the board of directors a whole lot of different things. You can read through that list, including increasing or decreasing the number of the board of directors, and compensation for the C-level employees, changing the number of shares, annual budgets, all those kind of things the preferred basically have to agree to. So even though the company may have still own over half the company in terms of common stock, the preferred shareholders have lots of power here. Questions or comments? There's other terms here. We talked about some of these. Again, I won't discuss these unless you have some questions on these. We have talked about pre-money. Anti-dilution says there's a future down round. We get some compensation for our prior investment. Things like that. Ready to move on? Okay, we're going to change gears now. You're now an expert on convertible debt and preferred stock. And we're going to talk about kind of how things look in the industry. And this is the source of this data is the Angel Capital Association, which we belong to. It has maybe half the angel networks in the US supplying data to them, the basis for these reports. Okay, so how do angels typically invest? Typically, we invest early in the revenue cycle. So you can see that for companies with no revenue or under 500K of revenue annualized, that gets the majority of the angel investments. Angels do invest later where there's big revenue, but not as often. So we're coming in early in the revenue cycle. We're coming in when the companies are small. So, half the companies have, or actually 75% of the companies have 20 or less employees. And it's not unusual to invest when they have 1 to 5 employees. We come in typically at the seed level, which is often convertible debt. And we come in less likely at Series B and C. Now, Series A is still pretty common also. And sadly, the majority of angel investments are still done to white males. And we do look beyond the CEO and say, who are the co-founders? Are there people who are underrepresented as co-founders, C-level people? And half of our investments have been to teams with a diverse C-level co-founder. And we work on that to make that happen. But yeah. So typically these companies, the total amount they're raising from all investors, not just from our network, is in the range of 500K to 3 million. And some of these numbers come from later rounds. And you can see, there's some variability year to year. And the amount that one angel group typically invests in a seed round, the very first round is typically under $250,000. Now that's kind of our average number, though it's varied for us between 500K and 50K. The valuations, the median valuations, you can see 6 million is a number here. That is the median for seed. It goes up to 8 to 10 for A, and then it keeps climbing. Series C is lower, which may imply there were some down rounds in those rounds. And it varies by region. California has, the world of Uber and Facebook and other companies have higher average valuations they give for their angel investments than we do. They list Texas at 8 million. It feels a little high compared to what Swan does, but those are the numbers. And then the valuations vary by industry. Those developing hardware need more cash, and because they can't give up too much of the company, they have to have a higher valuation to keep the kind of percent ownership for the company that's needed. And as you go down to SaaS and other e-commerce companies, software companies, the valuations are lower.
Bob, you know better than I do, but I think the other thing I think about when I think about hardware is that they have stuff, right? So they have assets that cost a significant amount of money, whereas an e-commerce or SaaS company has very few of those.
Yes. Well said. So that's a little just interesting data to help kind of provide a framework for where we are in terms of size of investments and valuations. Now we're going to talk a little more specifically about how valuations can work over time. And first thing I would say, here's some results from our angel network. So we've had one acquisition so far, Flow Below. They were helping improve the aerodynamic efficiency of tractor trailer cabs. They were putting fairings around the drive wheels. They were acquired in 2019 with a 36% internal rate of return for the Swan investment. We've had a couple of conversions of stock, two of those, Acadium and Yada, where we've seen a increase in the value of our investment by 13 and 17%. I say unrealized because we can't sell that stock yet. So on paper, at the current time, we've seen an increase in the value of our investments. Curb went through a merger. It was a stock swap. So no one got any cash out of it. We have now stock in the merging company, and that stock has a valuation that's currently gives us a 5% IRR compared to what we had invested. And then Bro, back in 2016, we made a loan. They paid us back in a year at 10% interest. A pretty nice deal for us for 1 year of low risk investing. So, and we've had two companies I didn't put on the sheet that went to zero. So we lost all that investment dollars. So changing subject briefly, looking at cap tables. A cap table says, here's a table of the capitalization, who owns what part of the capital in the company. And so, here's an example, an arbitrary example, saying how the two founders own 66% of the company, the employees, own 4%, and the stock owners own 13%, and there's still 17% out there fully for future stock options. So on a fully diluted basis, meaning that even unallocated stock options are included, it gets to 100%. And so what we like to see on a cap table is that the option pool be 10 to 15% for new hires, and that there's a vesting schedule for everyone, even the CEO who owned 100% of the common stock. We say, we want to put some of that stock back on a vesting schedule when we invest, so you have some kind of long-term commitment to this deal. And we like the CEO to have more shares than her or his co-founders. So it's clearly he or she is the boss. Any questions or comments? Okay, now we're going to go through spreadsheet details. In this model, we're showing that a company was bootstrapping and then raised a seed round from angels. And the bootstrapping, they put in $30,000 of their own cash. And they owned 100% of the company, which was 1 million shares they gave themselves a common stock. So it was 100% million shares for $30,000. Angels came in with convertible debt at $600,000. And now the total investment is $630,000. Angels have no ownership yet because the convertible debt is still debt. It hasn't converted. And so the employees still own 100%, and there's no valuation put on the company yet. Simple model. Now Series A happens. And in this model, VCs put in $3 million at $4.04 per share. And they negotiated a $4 a share. They negotiated a pre-money of $4 million I'm reading this wrong. Pre-money of 6 with the 3 in gives the 9 out. 3 plus 6 is 9. And so the post-money valuation is 9. Now, the angels converted and got 389,000 shares. The Series A investors have 742,000 shares, which gives the angels 17% ownership. And by the way, they increased the option pool slightly to make sure that the employees have enough ownership. So now the angels own 17% of the stock, and there's a post-money valuation of 9, meaning that the angels now have a valuation on paper, at least, of 1.6 million on an investment of $600,000. So that's a 2.6 increase in our value at the time of this investment happening. Makes sense? Questions, comments? Okay, so that's good. We're feeling good about this investment now as angels. Now there's a Series B and a Series C. Invested $8 million, $20 million. Share price goes up from $4 to $8.95 to $12.05. The post-money valuations go up from 28 million, to, let's go back. Wrong direction. Goes from 28 million to $60 million. Now the number of shares we have as angels stays the same, and the new investors get shares based on the stock price and the amount they invested. And now we own 7.8% of the company. But look at the money, the post-money valuation is $60 million. So that says that our value, our share of the company is $4.7 million, and we're delighted. That's an 8x return. So if the company got acquired at that point in time, we'd get an 8x return, and that IRR could be very, very positive, very interesting. So a series of up rounds, all good news. Company's doing well, they're growing revenue, everyone's happy, the CEO has not been fired, and things are going great. Questions, comments? Well, let's look at the others.
At that point, what's your ability to exit at that point?
Until there is, there in some cases there are some ways for investors to sell their shares to other preferred shareholders, but generally we're not able to exit until there's a merger and acquisition or an IPO.
Okay.
There are times when it happens, but I wouldn't count on it. I've actually experienced it, and after I experienced it, I thought, well, that was weird that I was able to sell some shares before an IPO. So it does happen, but it's really rare. Usually you have to hold on to, as Bob said, a merger and acquisition or IPO.
And usually the provisions are there for the founders being able to sell some of their common stock is the most typical scenario you might see. And really sophisticated CEOs may build that into all the funding rounds, the right to be able to do that in terms of the closing docs. Okay, so same model here we had before for bootstrap, seed, and Series A. And Series B and C still have the same amount of money being invested we saw previously, $8 and $20 million. But the share price for Series B is $1.10 as opposed to $4.04 because the company is struggling. They've missed their revenue numbers. They aren't getting marketplace traction. They've had bad financial results. And so with they give the company now a pre-money valuation at Series B of 4, raising 8 is now post-money of 12. And look how many shares the Series B investor gets getting to buy in at the share price. They get 7 million shares. Now, what happens is that we still own our 389,000 shares, but our ownership's gone down to 4%. And our $600,000 investment on paper has become a $400,000 investment. And then Series C, still a lot of money coming in. Share price is down again while the company is still struggling. But the Series C investor says, I'm going to turn this company around. I'm going to replace the management team. I think if we make some changes, we make this company work. I'll give you a lot of money to do that. But I'm going to control things, and I'm going to drive the share price down really far. And now they get 94 million shares. Wow. And the angels end up with 0.3% ownership, which is looks like $80,000 for the 600,000 put in. And it can be worse than that. We've seen companies where the Series B investor came in and gave all the Series A investors $1, saying that's your return, you're out of here. And that can happen when the company has a choice of either going out of business or taking the terms of the Series B investor. And the Series B investor, forces everyone, Series A investors, to accept those terms, because at least they get $1 out of it as opposed to 0. Down round, ugly, we don't like it. Questions?
How prevalent is that versus?
Well, I was saying that
Upfront.
half our investments fail, right? So they go to 0, either through sooner or as opposed to later. And 1 out of 10% might be pretty big successes, and the other 40% kind of just stumble along and don't do a lot. So we hope that 10% gives us a total return on our total investment. So all that said, what do we want to do as investors? We want to help the company make us money. We want them to be wildly successful. We're going to be coaching them. We're making introductions. We're giving them the benefit of our business experience. And we will help them close the full round of funding they're looking for. And so, having good two-way communication between the company and the CEO and the investors is important here.
So just so I could give networks in general and our network a plug, I think that's one of the reasons I like the network, being part of a network. I've had some companies who come to me as an individual and said, well, would you invest? And I said, well, you have to go through this process that we have in our network. And then if we're all good with it, we'll all invest, or a number of us will invest. And they say, no, we don't like that. It takes too long, et cetera, et cetera. But I think what's happening with those companies is they're not seeing the forest for the trees. There's significant benefit, as Bob said, to having all the folks that are in our network be able to help them, provide connections, provide customers, provide coaching. And then on our side, to try to avoid this situation, Chris, that you said, how prevalent is it, is we try to avoid it by getting a board seat and helping the company move along the right path, and maybe coaching up a CEO that might need to be replaced, helping them get some coaching, helping them understand some of his limitations and be more open to being replaced at the right time. Now, having said all that, failures still happen.
Yep. So what happens after we invest? Sometimes we get a board of directors seat. Sometimes we get a board observer seat. The difference is that if you're on the board of directors, you have fiduciary responsibilities under the law. And if investors feel like the board has not been faithful in their duties to the company, the board of directors can be individually involved in a lawsuit. Board observers don't carry that risk. We can be on an advisory board. We can be an informal mentor, or we can be a paid consultant. Sometimes all those things can happen and have happened. In some of our larger investments, we have gotten board seats or been board observers. As Juan was saying, our network has been pretty active in supporting the companies we invest in.
So how does that work? Do you have a representative between the angel group and the company?
Yeah, so if we want to, one of our angels will step up to the table and say that they want to be involved. And it's a negotiation as to what role they might play. And if we're the lead investor, have set the terms and put in a fair amount of money, then a board seat is often available to us. If we're not the largest investor, we don't get a board seat. Typically, we might get a board observer seat. We've proven our skills to the companies during our due diligence process before we invest. And they get comfortable with who we are and the value we can add because of the type of deep dive we've done on their technology and their markets and their customers. And so they often are very eager to have us join them either as an advisor or a board observer or a board member. We had a situation, we just made an investment in a company called Sonus. They agreed to give us a board observer seat. I polled our group, said who wants to be considered for this board observer seat? And there were 4 people who raised their hands. And I said, I'm not going to decide. This has to be someone who's mutually agreeable to the company. So I'm letting the CEO interview those 4 people and decide who we'd like to have as an observer.
More typically what happens, Gail, is one of our members, we're all pretty active in the entrepreneurial committee. And so we'll be advising. So Bob probably advises informally, I don't know, 30 to 50 companies. I probably do about the same. After some time, one of those companies they'll be ready for raising money. And so we might say, why don't you apply this quarter to Swan? And so they'll apply. And if they get through, we've been working with them for 6 months, 12 months, 24 months, sometimes even. And it's only natural at that point that we say, we have a discussion, and usually it's the CEO who will say, would you like to be on the board after we raise this round of money?
So we like to see boards where there's an equal number of company reps, either 1 or 2, like CEO, CFO, and investor reps, 1 or 2 investors, and an independent, non-investor, non-company employee rep, who's sort of the tiebreaker and brings a lot of value in terms of market knowledge or technology knowledge. So we'd like to see either a 3-person board at the early stage or a 5-person board where the company doesn't control the board outright, or where the investors don't control the board outright, and we have a collaborative environment. It's important that all the people on the board approach their duties in a collaborative manner with each other. And so it's important that the CEO have that kind of style, and all the investors have that style. Someone who's the smartest guy in the room all the time can be very destructive on a board.
Have you got any correlation between the level of Swan involvement and the IRR of the investments?
We don't have any data yet because our one acquisition was done in 2016. We made a small investment, and then we had no board representation, and they were our first exit. But I do think that
That sounds like negative correlation, Bob. We need to rethink our strategy.
Yeah. Some of our more recent investments, fairly big ones in the clean tech environmental side, we've had strong representation on their boards, and we've been very helpful, we think. For example, Curb, we helped them negotiate their merger and give them enough kind of financial clout to have some clout.
We helped Yada. Yada just raised another round, and we were very helpful in them securing that next round.
Yeah. One last slide here on tax issues. The IRS defined a qualified small business stock, QSBS. It has to be a domestic C Corp, like a Delaware Corp or a Texas C Corp, with annual revenues less than $50 million at the time we invest. And if we hold that stock for 5 years, we can exclude capital gains from our tax returns. If we have capital gains and reinvest in a new QSBS in 60 days, those capital gains get deferred to the future. And if we're in the first $1 million of equity investment, not convertible debt, but equity, and the company fails and we lose that money, we can take that tax write-off against income and not capital gains, which is a much more powerful way to get some tax advantage. Capital gains, you may be 20% of that loss gives you an advantage on your tax return. If it's income, 100% of that loss can be written off.
Those tax rules are for Swan. What about the individual members of Swan and the investors? Do they get K1s or what?
So those tax laws, whoever it was who gave the money to the company, it could be an LLC was created to give the company the money, in which case those tax benefits would accrue to the LLC, the special purpose vehicle.
Yeah.
It could be that individuals gave that money to the company, in which case those tax advantages accrue to the individual. And so we have in about half of our investments created special purpose LLCs to invest. And yeah.
And they give out K1s.
They give out K1s.
Okay.
And in some cases, we've invested in LLCs and become a partner in the LLC, in which case K1s happen there also, directly from the company to the investors.
Okay.
Juan has some experience with that.
I do. It's a thing you have to keep an eye on.
So that's all the material we prepared. There are a couple of really interesting books. If you were in the 201 presentation, this is old news. They're both pretty accessible, pretty easy to read, but very comprehensive. You can find those on Amazon at reasonable prices. And again, you can download this presentation from our website. There is a lot of good education stuff at the Angel Capital Association that you can go and reference. And if you haven't done it yet, next quarter we'll run the Angel 201 class that talks about building a portfolio and doing due diligence. And we have coming up next week our Angel Investing 203, how to impact investors, measure impact. How do we think about the good we're doing in the world? How do we try to quantify that? Because we have two bottom lines: revenue, business results, and doing good. Let's try to make it more than just a good idea that we hope it works. Let's try to measure what we're doing. So the final slide here in our final 2 minutes. We love to have feedback because we're always working to make these slides better. Juan had not seen this version of the slides before. What was helpful? What was lacking? What would you like to see more of, less of? We love that kind of feedback.
I think it was about right for me.
Thank you, Chris. Gail, you're kind of new to this world, I think.
I am, yes. A lot of information I'm trying to process, but I mean, I think it's really helpful to find out how it's done and get some of the key terms and you know, what you're looking for and what can happen and you know, when you actually get to hopefully make some money on an investment and things like that.
Yeah, you have to be patient because this is going to take 5 to 7 to 10 years to give you your return. So you only can invest that money that you don't need in the next 5 to 7 to 10 years.
Actually, that raises an interesting question. What are the succession plans within Swan, given the long time horizon?
Well, yeah, that's a great question. I hope I stay healthy. So, you know, Juan is very knowledgeable about the group. We have an admin who's learning some of the details of the group, but we don't have a well thought out succession plan.
We also have a very active board, but a succession plan is probably a good idea, a formal one. I think we have an informal one based on the board, myself and the intern, but probably it's about time to do a succession plan. But right now it's informal through the board and Bob and myself.
Avoid buses, Bob.
I'm sorry?
Avoid buses.
Avoid buses, yes. Avoid COVID. We're being very careful about COVID at our house because my mother-in-law lives with us and she's 104. So we do not bring COVID home. Jennifer, you have some questions or comments?
Yeah, I was going to say, I thought it was very helpful. I'm still processing a lot of it. And for me, it's just being able to kind of find the sweet spots and the right groups to invest in, to be honest. Being able to evaluate and using all these tips and all this useful information and consideration before moving. But I'm very excited about, you know, the potentials in the years to come.
Thank you. Jay, do you have some comments or questions? We're not hearing you, so. Well, thank you for your attention. Thank you for your comments and questions. This recording will be available if you want to go back and painfully sit through it again. So, oh, Jay, there you are.
Oh, okay. No, I was just saying I learned a lot. It's really interesting for me because I actually did some work for the Buena Vista Angel Network in Houston. It's interesting to see, you know, how the methodologies are both the same and different. So I really enjoyed this. Really learned a lot, and I think the rest of my impact investing team at UT Austin will be on the call on Thursday.
Good. Thank you. Okay, so we'll end the call now, and thank you for participating. And let us know if you have any questions. Those of you who paid for the webinar, we give you a discount on your first year's Angel membership if you like, or we will refund. We do the paying because there's so many no-shows that it was frustrating to us. And so if you did pay and are not planning to become an angel, let me know and we will mail you a refund check. But if you paid the $20 and become an angel, we'll give you $50 off in your first year's membership. So there
That's
you go.
your first IRR right there.
You made a down payment already.
Sign up for all three.
There you go, $150 off. You're going to be a rich man, Chris.
Okay.